Hey, it's Rick. It's Monday, October the 9th. Happy Thanksgiving for all of you in Canada. For me, it was a working day today because the US markets are still open. Um, the broader market is in sort of a tough spot right now. But in this video, I'm going to try and make a little more sense of it if I can, and explain how I'm approaching it uh, in the weeks ahead here, or at least the next week. Um, I have up here, as usual, a 1 week chart of the S&P 500. The blue line represents the 10-week moving average, and the white one is the longer-term 30-week moving average. And as I've said many times before, you get below this white 30-week moving average, nothing good happens below that, and it's time to get out of the market. When you have the situations we did back here in mid 2020, when you have a rising 10-week moving average, the 30-week was flat, but then started to rise up. You have, in this environment here, when these two averages are moving up like this, that's relatively a safe environment to be 100% invested. And in fact, I would highly encourage investors to adopt that approach. When price gets below the 10-week moving average, but hasn't yet touched the 30-week, is a tougher decision to make. I have my own rule. If I'm investing in the indexes, when price crosses the 10-week, I will reduce my exposure from 100% down to 75% or even 50%. And then if we do take out the 30-week, that's my signal to go 100% cash. So, but to each their own. So if you want to be more conservative and less proactive, you could just say, as long as we stay above the 30-week, I'll be 100% invested. And if we go below, I'll go to cash. So I like sort of a little hybrid version of that. So anyway, in 2022, in early 2022, the 10-week started to roll over. Price got below it. Was a clear signal to start reducing exposure. And in fact, there was a more clear signal in the middle of January just to get out of the market altogether. And I think this was about the time I started doing my blogs. I'm not sure. I think that was actually back here somewhere. And then certainly by March, April, when we hit this period here, I recommended to everybody, like, get out of the market, get into cash. And we've been, for the most part, we were there all of 2022. Because we've had this declining 30-week and 10-week moving average. The beginning of the year, things changed a bit. We crossed above. The 10-week started to move positive. The 30-week was flat, but then started to rise. So around March, April, we were back to pretty well 100% invested. And it worked out pretty well right through to the summer, into August and September. Now, in a previous video, I talked about August and September being historically the two worst months for the market, and this year didn't disappoint in that regard. We came down fairly hard in both August and September. So this triggered me to lighten up my position, especially now that the 10-week moving average has started to roll over. The 30-week is still in an uptrend. So that's why I say we're in a period here, like what to do. So certainly personally, once we took out this low here of, what day? That was in the middle of August, yeah, August 14th. By this period in here, the third week of September, I was virtually 100% cash. I think I got to 92% cash, and I had one or two very tiny positions. And I remained that way as we sort of trying to get a footing on the market. So what I'm looking for now is some sort of other indications or that where are we going to go from here? Is this 30-week moving average going to hold, and the 10-week will start to turn back up again, or are we going to roll over and just have a nosedive? So just looking at this chart, that's really a coin flip. So which is why I'm still very lightly invested. I don't get much help if I go to the QQQ, see how it's doing. I think it's pretty much a mirror image. If my chart ever loads up, what's going on? Okay. Oh, there we go. This is the QQQ equal weight, but it gets the same sort of picture. And the other one I look at, I'm paying much more attention to these days, is the S&P 500 on an equal weight basis. And the symbol for this is RSP. The S&P 500 is, as we've talked about before, is a market-weighted index. So it is highly dominated by the big trillion-dollar market cap companies like Google, Meta, Facebook, Apple, Microsoft. And I think those big seven account for about 20% of the weighting of the S&P 500. So more and more, I prefer to use the RSP, which is basically an equal weight of the same 500 stocks, and to me, it gives a truer picture of what the market is doing, as opposed to just being driven by the big seven. Anyway, so the RSP is really in nowhere's land here. It's like we're 10-week moving average is down, the 30-week is flat. We're basically exactly where we started the year. So it's been no gain, no loss, actually a slight loss. So this doesn't help, although this week is off to a good start. So I look at other things. I look at it and say, well, what are bonds doing in the meantime? Oops. Well, okay, that's not good. Then I look at the US dollar. And the US dollar is really a sort of a contrary. Has a contrary, or it's not the right word I'm looking for. But anyway, as the US dollar gets stronger, that's not good for US equities. And so this period of strength here in the last few weeks has been why the market has pulled off. And the same thing back here when the US dollar got strong from the middle of 2020, late 2021 up here, the market was weak. So this tells me it could be extended, but this is not good for the equities. So that don't know what yet to do. So I look at one more. I'm going to flip over to a daily chart here. And there is an indicator, or a chart rather. I'm going to move this weekly chart out of the way. And what this chart represents is the number of stocks that are trading above their 200-day moving average. You've heard me say many times before, nothing good happens below the 200-day moving average. And if you have the predominance of the stocks on the New York Stock Exchange trading below the 200-day moving average, this is not a healthy environment. And then currently, so last week, we were around 32% of stocks are trading above the 200-day moving average. And that's starting to tick up a little bit. So that means 68% of them are trading below. So that's not a healthy environment. But the interesting thing with this, if you're looking at just the price, we go back to the S&P as an example, and you go back to a standard price chart. Come on, charts, what's going on? Okay. Oh, there we go. You can look at the price, but it really doesn't help you say, is this going to go up or down from here? You know, you're more or less guessing. You know, you get into this period in here, and it's been going down, and then what's to say it's not going to keep on going down? It's just a guess. what I keep calling a coin flip as to which direction we're going to go. And I don't like coin flips. I like to put the probabilities on my side. So one thing I've been paying more attention to is, go back to this one, the number of stocks trading above their 200-day moving average. And just scroll back over here. This is mid 2022, this period in here. We got down to like only 12-13% of stocks were trading above their 200-day moving average. So clearly that's signs of a really weak market. But how much more weak can it get when, I suppose you can get to 100% of the stocks are trading below their 200-day moving average, but that's not highly probable. So the probabilities are that I think you're going to get a bounce in the market. And then the number of stocks increased up to around 38% and then fell back again. And then in September, October 2022, we got down again around 14 or 15% of the stocks were trading above their 200-day moving average. So I got to thinking, these periods of time in here since the last year, they haven't been as deep, but we've gotten down to this 34-33% area. And then it seems that the number of stocks trading above their moving averages tends to rebound from there to some extent. So if I extrapolate from this, I put the RSP, the equal weighted S&P 500, the price chart, and put that on this chart. You can see here's what happened. So again, to reiterate, when you get this kind of price movement, it's a coin flip. Whether are we going to go up or down from it? We don't know. Prices like this was I don't even know what the price. Oh, here's the price here at $132. Is it going to go to 100? Is it going to go back up to 150? We don't know. It's a coin flip. But if you look at the percentage of stocks that are trading or have a price above their 200-day moving average, and it's only 13 or 14%, there's a higher probability that this is pretty close to a bottom. Sure enough, it bounced up here again, but then we had a nice little run up into here. From the price went from $132 to $152. So percentage terms, that's not insignificant. And then the same thing down here. We got down to like 15-16% of the stocks are trading above. And then sure enough, that resulted in a price rise. So again, in this period of time here, we're in the 30% range. And every time we get down there, we get a lift. We get a lift. We get a lift. We get a lift, maybe? Who knows? The probabilities, though, suggest that the market's going to go up from here. Now, how high is it going to go back up to the previous highs? No, we've got to wait and see. Could it roll over and go right back down again? And the number of stocks trading above their 200-day moving average drops down to 20%? Absolutely. Again, that's why we have stop losses. But to my eye, the probabilities now favor a move towards the upside, even though the chart looks kind of ugly. So we'll take this off and go back to RSP. So what's this doing here? Okay, take this off. So let's just look at what's happened the last couple of days. So this was last week, last few weeks, we've just been straight down. So, the expectation is that we're going to continue to go down. In the absence of looking at the other chart that said, hey, we're already at 65% of the stocks are trading below their 200-day moving average. So Friday comes along. And what happens on Friday? We gap down. Here's where we closed on Thursday. Friday morning, we gapped down, went lower for the first, I think I haven't got an hourly chart up here, but it was the first hour or so, and then ripped higher all day long. And this was the highest range bar, positive or negative, that we've experienced for some period of time on high volume, much higher than normal volume. So that was an interesting day, to say the least. Based on that, I opened a couple of new positions. I increased my exposure from 8% to around 20%, 21%. And then of course, I learned the news of over the weekend, the war in Israel. And I thought, oh, this can't be good. Checked the futures market this morning, and the futures look to be gapping down about 1%. But oil was up 3.5%, which generally is not a good thing for the market. So anyway, it opened gap down. I think more or less about 0.6%, 0.7%, something like that. And that was the low of the day, and then just ripped higher all day long today. So I added a couple more positions. So I'm now at 33% invested. So now that doesn't mean, are we going to roll over from here and go right back down? It's entirely possible. That's why my stops are really tight. But I think, I hate to say this necessarily and go out on a limb, but we posted a low back in here in March of 2023. That was the low for the year on the RSP. We didn't come down that low here. And then the last few days we undercut this, and then have now rebounded. So considering that the last couple of weeks of October and November, December, even January are historically strong months, I think there's a good probability that we're going to have a nice rally into the end of the year. So that's why I'm positioning myself accordingly. Now, I won't go more than 33% invested. I'm going to put some moving averages on here. So this, the yellow one is the 10-day moving average. The red is 21-day moving average, and the blue is the 50-day moving average. Now, generally speaking, I don't want to be, I will never get full, I would never say never, but will not get fully invested until we get above the 50-day moving average and the moving average is turning up. So that's quite a few days or even weeks away. However, I do have a rule, or I'm now establishing rules that say if price gets and stays above the 8-day moving average, I will go to 33% invested. 25% ideal, but as much as 33. I'll stretch I'll lay this out in an email, but I stretch the rules. If my total portfolio risk is less than 1.5%, then I will go to 33%. When we get above the 21-day moving average and this starts to curl up, I will go to 50% invested. And then I will go to 100% invested when we get above here. So it's a process. It's you don't go all in, because if this just flips over and rolls back down, this is what's that's 2.5 to 3% loss. I don't want to lose 3% of my entire account when we're in still a very risky situation. But if I have a third of my account invested and everything does roll over and we get stopped out of everything, I lose 1%. Not a big deal. So that's why I progressively expose, only get towards fully invested as the conditions in the market dictate. So I hope that makes some sense to you, sort of my thoughts on where I'm at. It's an approach that I would highly recommend, and it's sort of how you go from being 100% cash to gradually getting invested. You just don't do it all at once. Okay, more updates. This is going to be an interesting week for the market, I think. So I may have an update later in the week. Cheers.